Falling exports, slowest GDP growth in a decade, and some economists are talking about the possibility of a recession for the Singapore economy. We look at why and what that means. As you might have guessed, the US-China trade war, which has been going on for more than a year now, is one of the biggest risks confronting the Singapore economy. The conflict is a threat to global supply chains and economic growth and has already impacted global financial markets and business sentiments. There are also fears that the recent expansion of the conflict into the technology space will cause even more uncertainties. Singapore is a small and open economy, and as the US and China ranks among the country's biggest trading partners, it is inevitable that we feel some impact. So far, the electronics and precision engineering clusters within manufacturing, as well as other externally oriented services sectors such as the wholesale and retail trade, have felt the biggest impact. There are already reports about manufacturing companies here who noted falling orders and sales. These include companies that manufacture products for Chinese companies, which are in turn shipped to the US. This can have a ripple-down effect on supporting services. For instance, if there are fewer exports, there will be less demand for, say, logistics services. There will also be less demand for trade financing, which will in turn impact the banking sector. Now, this is happening alongside another headwind, that is weaker demand in the global electronics industry, causing a double whammy and further strain on the local manufacturing sector. Other risks highlighted by the Singapore's Ministry of Trade and Industry include the possibility of slower than expected growth in China, as well as the possibility of a no-deal Brexit. Economists are also looking out for new tensions between Japan and South Korea. Japan recently restricted exports of high-tech materials to South Korea. Recent economic numbers seem to paint a worrying picture. The latest non-oil domestic exports for June showed a double-digit decline for the fourth straight month. At 17.3%, it was the biggest drop in 6 years. Singapore's exports could decline further in the coming months, according to economists, given the broad trade slowdown seen across other Asian economies. Last week, we had preliminary GDP estimates for Singapore in the second quarter. Now, flash estimates are computed based on data from April and May, and they already showed the economy growing at just 0.1% year-on-year in the second quarter. This is the slowest growth in 10 years and also marks a sharp slowdown from the 1.1% growth in the first quarter. With that, more economists are warning that there is a high likelihood of a technical recession ahead. A technical recession is defined as 2 consecutive quarters of negative quarter-on-quarter GDP growth. As for how much growth the Singapore economy can clock for the full year, private economists have trimmed their forecast to as low as 0 to 1%. The government is also expected to revise its official growth estimates next month. To be sure, it's not all doom and gloom. Deputy Prime Minister Heng Swee Keat has said that the government does not expect a full-year recession at this point, given that there are strengths in the economy still, such as the information and communication sector, as well as the construction sector. The Economic Development Board is also on track to achieve its foreign investments targets for 2019. This is according to Trade and Industry Minister Chan Chun Sing, who said that this is due to Singapore's advantages, such as a stable political environment and the rule of law. The topic that most, if not all, Singaporeans are concerned about is probably jobs. Unfortunately, some impact is already beginning to filter down to the workers here. For the first quarter, statistics from the Manpower Ministry showed a rise in retrenchments. Now, this was driven mainly by job losses in manufacturing, which affected production and related workers in electronics. Among retrenched residents, the majority are professionals, managers, executives, and technicians, or what we call the PMETs. This trend of rising retrenchments is probably going to continue in the coming quarters, according to economists that I spoke to. Apart from manufacturing, they're more worried about weaker growth in the services sector and how that might translate into employment opportunities ahead. Nevertheless, Manpower Minister Josephine Teo says there are still jobs out there. She put the number at about 60,000, and these job vacancies can be found in sectors such as the information and communications, professional services, and financial services. As the economy transforms and technology advances, new jobs will also be created. The Manpower Minister also said that there are initiatives right now that can help workers who require training to transition into new jobs. While the government is closely monitoring the situation, Singapore's strategy amidst all these heightened uncertainties and risks in the global economy is to continue focusing on the long term. This is a point made by several cabinet ministers so far. Trade and Industry Minister Chan Chun Sing has said that instead of artificially boosting demand in general, Singapore should continue to focus on attracting high-quality investments for the long term and help workers and companies adjust to the new realities by strengthening long-term fundamentals. These include building real and new capabilities, expanding into new markets, and acquiring new skills. Still, in the near term, given the recent weak economic data, experts think it is possible for the Monetary Authority of Singapore to ease monetary policy in October, when the central bank holds its second policy review for the year. Easing monetary policy will mean a weaker Singapore dollar, which translates into support for exports and growth. Given the government's comfortable fiscal position, experts also think that it is possible for the government to roll out counter-cyclical fiscal measures when required to offer more support for businesses and workers.